Hi, I'm Andy Temte, and welcome to Money Lessons. Join me every Saturday morning for bite-sized lessons that are designed to improve financial literacy around the world. Today is January the 10th, 2026. Last week, we explored how the Great Depression exposed fundamental flaws in bond markets and triggered regulatory reforms. The Securities Acts of 1933 and 1934 created mandatory disclosure requirements and the SEC, or the Securities and Exchange Commission. The Trust Indenture Act of 1939 strengthened bondholder protections, and Glass-Steagall separated commercial from investment banking. These reforms established the framework that protect bond investors today. We ended by noting that these regulatory foundations would enable the modern bond market's explosive growth. Today, we're discovering how World War II's aftermath and the technological innovation transformed bonds from niche investments into the massive liquid markets that finance our global economy. So, picture America in 1945. World War II has ended, leaving the federal government with massive amounts of debt, over $250 billion at the time. Sounds small today, but it was a lot of money back then. And this represented roughly 112% of gross domestic product, which is really high. As a reminder, today, here in early 2026, our federal debt as a percent of GDP is about 120%. So our debt burden is really, really high today in historical terms. So millions of Americans had bought war bonds at the time. Banks and institutions held billions in Treasury securities. And this created something entirely new after World War II, a massive liquid market for government bonds that became the foundation for the entire fixed income market. Now, Treasury bonds became the de facto benchmark, the quote-unquote risk-free rate against which all other bonds were measured. If a 10-year Treasury bond yielded 3%, corporate bonds had to offer more, maybe 4% for high-quality companies and 6% for riskier ones. This credit spread, or the difference between the rate of return on a risky bond and the risk-free rate, became the standard way to price credit risk. We're going to talk about the credit spread in much more detail in later episodes. Now, throughout the 1950s and 1960s, three types of institutional investors emerged as bond market powerhouses. First, pension funds exploded as companies established retirement plans. They needed safe, predictable returns to pay future benefits. Bonds were a perfect solution. Then, insurance companies, expanding as insurance was democratized, they needed ways to conservatively invest the premiums that they were collecting from policyholders. Both became voracious bond buyers. Then, mutual funds also created bond funds, letting ordinary investors like you and me buy shares in diversified portfolios rather than selecting individual bonds. This made bond investing accessible to middle-class savers who couldn't afford the $1,000 or $5,000 minimums that many individual bonds require. These institutions fundamentally changed markets. When bonds traded mainly among wealthy individuals, markets were small and illiquid. With institutions managing billions, trading volume soared and liquidity improved dramatically. However, throughout the 1970s and the 1980s, bond trading remained surprisingly primitive. Unlike stocks trading on exchanges like the New York Stock Exchange, most bonds didn't trade on any exchange at all. You'd call a dealer, you'd negotiate prices, and you'd complete the paperwork manually. This created massive inefficiencies. Prices varied between dealers, information was fragmented, and transaction costs were high. We've seen this movie before, haven't we? In the 1990s, electronic trading platforms finally began transforming bond markets. Companies like TradeWeb and Market Access created systems where investors could see multiple dealer quotes simultaneously and execute trades electronically. Bloomberg terminals became essential tools providing real-time bond pricing and analytics. These platforms improved transparency dramatically. Investors could compare dealer prices instantaneously, driving competition and reducing transaction costs. Information that once required calling multiple dealers could be accessed with a few keystrokes. Now, the Treasury market led this transformation, and by the late 1990s, most Treasury bond trading occurred electronically through platforms that matched buyers and sellers automatically. Corporate bonds lagged behind. They remained more dependent on dealer relationships, but even corporate bond markets gradually adopted electronic systems. Bond markets also internationalized. Back in the 1960s, the Euro bond market emerged. These were bonds issued in currencies outside of their home countries, and this accelerated through the 1980s and 1990s as capital controls loosened and communication improved across borders. For example, investors in Tokyo could buy U.S. corporate bonds, and European pension funds invested in emerging markets around the world. Globalization created benefits and also risks. Money flowed where returns were highest, improving capital allocation, but problems in one country could quickly spread globally. The 1997 Asian financial crisis demonstrated this when falling bond prices in Thailand triggered selling across Asia. Now, the final democratization came through exchange-traded funds, or ETFs. ETFs allowed investors to trade diversified bond portfolios just like stocks, buying and selling throughout the day at transparent prices. The first bond ETFs launched in the early 2000s, and by last year, in 2025, bond ETFs managed approximately $1.5 trillion in assets. This transformed bond investing for ordinary investors. You can now buy exposure to treasury bonds, corporate bonds, municipal bonds, or international bonds with a single trade costing less than $10. This accessibility created what earlier generations couldn't imagine. A school teacher can build a diversified portfolio with $1,000 and a smartphone. The barriers that once limited bond investing to wealthy individuals and institutions had essentially disappeared. Today's bond market is enormous and really diverse. As of 2025, the U.S. bond market totals well over $55 trillion. This includes $30 trillion in treasuries and agency securities, $11 trillion in corporate bonds, $4 trillion in municipal bonds, and several trillion more in mortgage-backed securities and other instruments. This market finances everything from government operations to corporate expansion to home mortgages. When the government needs to fund infrastructure, one tool at their disposal is to issue bonds. When companies need to build factories, they can secure project funding by issuing bonds. When home buyers secure a mortgage to purchase a home, banks package these mortgages into bonds that are called mortgage-backed securities. The modern bond market emerged from the regulatory foundations that were laid in the 1930s, expanded dramatically after World War II, professionalized through institutional investors, modernized via electronic trading, and globalized as capital moved freely across borders, and then finally democratized through ETFs and mutual funds. Understanding this evolution helps us appreciate what we have today: liquid, transparent markets where ordinary investors can participate alongside institutions, building diversified portfolios that previous generations couldn't access. Next week, we'll shift from history to practice, exploring how bonds actually work, what you're buying when you purchase a bond, how bond prices move, and why understanding these mechanics matters for building your wealth. Until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with your friends, your family, your colleagues, and maybe a neighbor. The show was produced by Nicholas Temte, and we'll see you next time on Money Lessons.